Good morning, Ed.
Morning, James.
Thank you very much for doing this. You start off by telling us a little bit about HICL, please.
Yeah, no, thank you very much. Look, very quickly, I'm Edward Hunt. I'm a partner at Infrared Capital Partners, HICL's investment manager. I joined the firm back in 2008, came through the investment side of the business, and I'm the fund manager for HICL. Um, Very pleased to be talking about HICL today. It is very timely. We announced HICL's annual results for the year to 31 March just on Wednesday. So I plan to give a flavor of those results alongside a few introductory slides on the company and its strategy. So let me do that, starting with this slide, slide 2. HICL is a FTSE 250 investment company specializing in direct infrastructure investment. It was launched in 2006. It was the first infrastructure trust listed on the London Stock Exchange, and with a portfolio value of over £3 billion, it remains one of the largest and most liquid. So what does HICL seek to do? Well, HICL is a core infrastructure investor, and it offers shareholders the ability to access direct investment in the critical infrastructure that they rely on in their daily lives. So these are essential assets which deliver resilient inflation-linked cash flows and also stand to benefit from exposure to powerful infrastructure megatrends. So in investors' hands, that translates to reliable income, capital growth in a highly liquid and diversified vehicle. We manage the portfolio actively to deliver outperformance, working to realize the potential of each asset, whilst also enhancing the portfolio overall with timely divestments and highly selective acquisitions. Every asset in the portfolio plays a role in the delivery of HICL's investment proposition, and our model is to review that judiciously. And then finally, on the right-hand side of the slide, the pedigree, the track record of the company and Infrared as manager. Over the 18 years since IPO, the company has returned an 8.7% per annum return on a NAV basis, and that's been through all manner of market conditions. And that's delivered by a specialist manager in Infrared with over 160 people and 25 plus years of investing in infrastructure globally. Turning over to slide 3, I mean, I've mentioned the term core infrastructure a couple of times, and this slide sets out what we mean by that. When Infrared first moved into infrastructure investment in the late 90s, and indeed even when we launched HICL in 2006, infrastructure wasn't really a distinct asset class. For investors, it sat somewhere between real estate and private equity. And over the years, there's been a huge influx of capital into the sector. And with that, the sector's grown, it's matured, and it's also become broader, meaning different things to different people. And within that, we see different levels of risk and return. The term core infrastructure really defines the lower end of the infrastructure risk spectrum, and it's become synonymous with assets that exhibit the most coveted infrastructure characteristics. And for us, it boils down to 3 key attributes, which you can see here on the slide. So firstly, high cash flow quality, typically through contracting, entrenched demand, or regulated revenues. Secondly, defensive market positioning. By that, we mean high barriers to entry, low levels of competition around the asset. And thirdly, criticality. We're looking at essential assets that provide the backbone to our society and therefore operate with strong social license. So taken together, we're looking for essential physical assets delivering resilient cash flows from a protected market position. This very much describes HICL's portfolio. It also guides our approach to acquisition screening and our due diligence processes. Actually, when we're looking at acquisitions or disposals, the front page of the investment paper will have an assessment of the core infrastructure characteristics set out against these 3 categories. So just because we know what we're looking for and the fact that we're looking for the same three things in every asset doesn't mean that all assets look the same. And slide 4 gives you a sense of the portfolio more broadly. Investors buying a share in HICL buy instant diversification to a high quality portfolio. And you can get a sense of that here on this slide. We have a broad range of sector exposure on the left that spans utilities, roads, rail, digital communications, and social infrastructure, so things like schools and hospitals. And on the right, you can see the company's top 10 assets. So together, the top 10 equate to less than 50% of the portfolio, and single asset concentration is only 8%. And that's all very much by design and compares well against across the peer group. A deliberate mixture of revenue types. So you can see that illustrated by the different colored tiles on the right-hand chart. And it really depicts three different revenue types. So firstly, contracted revenues. That's principally through our public-private partnership investments, otherwise known as PPP or PFI. They span social and transportation infrastructure mainly. We also have our demand-based revenues. So that's things like toll roads or our investment in High Speed 1, for example. Or regulated revenues is the third key bucket. So that's typically utilities. These are monopolies where you have regulated pricing frameworks. And so that includes our investments in, say, water and our electricity transmission investments. Across the bottom of the slide, a spread of geographies. The majority of the portfolio remains in the UK, sterling denominated. We manage currency pretty tightly. Our active approach to portfolio construction is a central part of our business model. So we continue to refine this portfolio, particularly as markets, sectors, geographies evolve. And so we buy and sell assets to improve key portfolio metrics and to diversify risk. And that's also a key feature of HICL's recent annual results, which I'll turn to now on slide 5, really just providing some key headlines, and we can delve into any of this in the Q&A if you'd like. But in short, we announced another resilient result for HICL, very much underpinned by active management and capital allocation discipline in the year. And we can break it down into three key areas. On the left, we made over £500 million of divestments. That continues HICL's long track record of asset rotation, which now totals over £1 billion of disposals since IPO, contributing over 10 pence of NAV outperformance. Divestments in the period are particularly important for three reasons. Firstly, these were achieved with a combined 11% premium to carrying value, and therefore reinforces the quality and the robustness of the company's valuation and valuation approach. And it also illustrates what we would describe as a disconnect between public and private market valuations for high quality infrastructure assets. Secondly, the transactions provide a valuable source of funding, and that's enabled us to repay our revolving credit facility in full, to rotate into some highly selective acquisitions, and to buy back shares with a 50 million buyback program. And finally, and perhaps most importantly, the transactions support strategic portfolio construction and enhance the quality of the company's cash flow and earnings. And that really takes us to the middle column on the slide. So the board has guided a return to sustainable dividend guidance from FY26, so that's starting next April, and that's with guidance of 8.35 pence per share. So this reflects confidence in the cash flow generation from the underlying portfolio, as well as our efforts over recent years to diversify, to rotate assets in order to build out the long-term earnings platform for the company. And we wanted to do that in order to make sure that the dividend growth was genuinely sustainable over the long term. That is covered by both cash flows, but also by income. And thirdly, it's this platform that underpins HICL's long-term success in the right column there. So the portfolio has a defensive core asset base. It is also positioned in strategic infrastructure growth sectors. And from those positions, it can deliver both income and capital growth to shareholders. The current share price implies an expected steady state return of 8.9% net of fees. So that's adjusting our discount rate by the share price discount and then taking fees off the top. So at 8.9% net, that is a 4.8% premium to risk-free rates across our markets, and it's a 6.5% real return above our inflation assumptions. It's also important to note that of that 8.9% implied forward-looking return, shareholders receive a down payment on that of over 6.5% via the dividend yield alone. Our job as manager is to top that up further through outperformance, so actively managing the portfolio, but also by bringing that share price back towards the NAV through sound capital allocation and a compelling forward-looking strategy. I'll spend a moment on that strategy now on slide 6. So in recent years, we've been really very transparent with shareholders around our efforts to better position the company for long-term success and to construct a portfolio that will underpin the delivery of shareholder value for decades to come. So recent transaction activity over the years has deliberately extended HICL's revenue streams. It's introduced assets positioned to capture real growth and to balance the increasing maturity of the group's concession-based assets. So the PPPs typically they're finite life assets, and they are maturing and will eventually the valuation will go to zero. This strategic evolution is now reflected in HICL's asset base, and you can see that on this slide set out in terms of portfolio cash flows. So we have mature, shorter life assets providing a strong yield. That's our PPP assets, our concession-based assets. And that's complemented by assets with longer life, stronger inflation linkage, and greater growth potential. So that's those more recent investments beyond PPP. So to illustrate using the slide, you can see HICL's yielders deliver a forecast 10% annual cash yield against a weighted average life of 14 years. And that's balanced with HICL's growers, which are forecast to deliver a 10-year annual growth rate of 7% from an average asset life of 48 years. So naturally, as this second group matures, the growers of today become the yielders of tomorrow. And in this way, these complementary asset groups, they come together and they build an earnings platform capable of delivering long-term dividend and NAV growth for shareholders. This chart is a slight simplification in that it assumes no changes to the portfolio mix or the portfolio assumptions. In reality, what will happen is the company will pay out a large element of these cash flows as a dividend, and will also reinvest a portion. So this reinvestment's not shown on the slide, but it will enable us to grow out the back end of the chart, so the right-hand side of this chart. So if you look at the rolling valuation, which is the dotted line that goes across the chart, through reinvestment, our forecast is that we'll be able to lift that valuation in 2050 by £900 million to £3.1 billion valuation. And that supports the NAV and the dividend long term without requiring access to external capital. So one final slide on the outlook, slide 7 here, and then we can get into some questions. Appropriate and effective capital allocation remains front of mind for HICL's board and InfraRed, recognizing in particular the shareholder discounts that prevail across the share price discounts rather that prevail across the sector. Capital allocation has been central to the decisions that we've made over the year to accelerate strategic disposal activity, to completely repay our floating rate debt, to launch a 50 million buyback program, to increase the dividend from next April, and to execute highly selective acquisitions when there is a compelling risk-adjusted return available. It's recognised that the bar for new investments remains very high. That's informed by the relative proposition offered by additional share purchases. We are seeing pockets of opportunity in the market, and where those do offer compelling risk-adjusted return, require only modest debt drawings, and are expected to materially enhance the portfolio, we will look at these selectively on a case-by-case basis. Equally, we also continue to explore selective divestments, as we always have done, where there is a compelling strategic rationale. And I should note that all investment and divestment decisions continue to go via HICL's board as an extra layer of governance. I think longer term, it's important to recognise that the outlook for infrastructure investment really remains very positive and very supportive. So what we have in the outlook is underlying infrastructure investment needs continue to be pushed at pace by these three powerful megatrends of decarbonisation, digitisation, and demographic change. And these are really driving forward the need for infrastructure investment. We also see a state of infrastructure decay across HICL's markets, and that is matched, frankly, by the fragility of government balance sheets. There's also increasing competition now between jurisdictions globally to attract much needed investment. So these conditions come together, and they really provide a foundation for greater use of private capital to support infrastructure development. And we expect this environment to be strongly supportive of the company's strategy going forward, including with respect to HICL's existing portfolio. So I'll leave it there, James. That's all the prepared remarks, but very happy to take questions from you and your listeners.
Great, thank you very much. So obviously, if you've got a question, please do put them in the chat box on YouTube. Couple come through already, but one I'd like to sort of kick off with, I think. It's quite interesting because it seems a long time now ago that we talked when you first launched, and you're buying all these PFI things with enormous long maturities. But will you hold any of these to maturity, or will you try and sell them before they get there?
Yeah, it's a good question. We will, as I noted, I mean, we do look at disposals, but it has been to date, broadly £1 billion of disposals versus a valuation that's been as high as £3.7 billion. So we do rotate assets selectively. I think the way that we approach disposals is it's very quantitatively driven. So we look at each asset's contribution to return, yield, inflation correlation, and asset life, and we look at which assets are underperforming in any of those categories, and then evaluate whether it would be better to dispose of the asset. Now, the dynamic you'll have with the PPPs as they approach the end of their asset is that the asset life will be shrinking, but the yield will be quite strong, and that's going to be one of the key drivers of reinvestment and that dynamic that I mentioned. So certainly we have already handed back assets. We have a small number of assets coming up for hand back in the next 5 years. And it is our expectation that we will hand them back. And we work very closely with the public sector around that process. So we're a member of the IPA, the Infrastructure and Projects Authority steering groups and working groups around hand back and around net zero. So we are an active industry participant in that hand back process.
And once you've handed them back, what happens to them? Are they just set on local authority or national government balance sheets, or are they going to restart the process again and do a new contract?
So the assets will absolutely still exist. So the assets will have an asset life ahead of them. Governments will bring them back on. Effectively, they will have paid now for the asset, both the debt and the equity, once over the 30-year concession. But they will continue to require management and things like facilities management, so um, cleaning, life cycle works, catering, all those types of things will need to be done. And our expectation is that the public sector clients will engage directly with companies that do this. So the likes of Bouygues Energy and Services, Serco, for example, big sort of outsourcers that will continue to do that work for them. So, that's our expectation going forward. They'll also need, to maintain insurances and things on these, and so they'll need someone to do that for them. But it will effectively fall on the public sector to continue to run these. And it's worth noting that over the next 15, 20 years, the government will be taking back 700 plus assets and taking the management of those back in house.
Yeah, fair enough. There's a specific question about, you sold a couple of hospitals. Is there anything in terms of like the asset mix where you decided to sell hospitals, or was it just those assets looked like fully valued?
So look, we always keep an eye on the concentration of the portfolio to particular sectors, and we have brought the health exposure down over the years, and we're quite comfortable with where it is. I think around the specific assets that we sold, they always have asset specific considerations. For example, Oxford John Radcliffe, which we sold as part of a package to John Lang, had previously been constructed by Carillion, which fell over. So we have had a role in that asset of tidying up the asset, the contractual framework, fixing up some construction defects. And we wanted to take the opportunity to really realize the efforts that we made on that asset in improving it, getting it back to a steady state, and then handing it on to someone else. So there's always an asset specific story around each of our disposals, and that was made a positive contribution to a number of those key metrics that I mentioned before: return, yield, inflation correlation, and asset life.
Cool. Okay. Affinity Water next. Obviously, that's a fairly large investment. What determines the sort of size of these things? Is it to do with the risk involved with them, or the return available, or is it a balance of both?
Yeah, it's a balance. I think at sort of starting point is that we try and limit single asset concentration to around 10% of the portfolio. We think that's about right for a portfolio such as ours. Technically, the investment policy allows a single asset concentration of up to 20%. So that's very much an active management consideration. I think then what is the appropriate investment size will often be determined by the level of governance that can be achieved for a certain investment size. So on Affinity, the investment size equates to a 33% holding for HICL, and that affords us a board seat and an equal larger share alongside the other co-shareholders. So that's really important as well, both to have the appropriate formal governance on the board, but also to have a share that stacks up well against our co-shareholders, so that we can exercise influence on the board and over the management team. So they're the key considerations around an appropriate investment size and how that stacks up within the existing portfolio.
I'll mute myself again. Do you think the geographic balance is going to stay more or less where it is, or do you think that might change?
Yeah, I mean, it's been coming down, the UK proportion. So at one point in time, it was almost entirely UK. We had a Dutch asset in the IPO portfolio as well, and that really reflects two things. Firstly, pipeline. So as infrastructure as an asset class has matured, we've been able to see very high quality and supportive frameworks around assets in other countries, and we expect that to continue, and we see large pipeline for high quality assets, in particular in Europe, North America, and selectively in Australia and New Zealand. I think the other key factor that's driving it is diversification. With infrastructure investment, there is always an inherent risk around political regulatory exposure. And it makes sense in that context to operate in a number of jurisdictions so that if there is a political situation in one country, it doesn't bleed across the entire portfolio. And even within the UK, where we are predominantly focused, we do spread the risk across different sectors, different clients, different revenue types, in order to manage that counterparty exposure. There's also a currency consideration. So the more we do hedge currency, we try and limit the impact of currency movements on the NAV. And so the hedging burden increases with the amount of non-sterling denominated assets you have. So, we've got a predominantly UK shareholder base, a predominantly UK asset base, and we're domiciled in the UK. So I would expect us to remain at least, majority UK for the time being.
Okay, that makes sense. Thank you. Now you've more or less paid off your credit facility. Is that because the interest rates went up and it's no longer makes sense to use it, or is this a temporary thing that you might bring it back again? Or would you even consider putting sort of more permanent gearing into the structure?
Yeah, so these revolving credit facilities were never really designed to be permanent. They were always envisaged as a bridge between making new investments and then bridging to capital market issuance, typically an equity capital raise. So as equity markets are closed to these companies on the basis that we trade below net asset value, it made sense to bring that down. Also recognizing that it's floating rate and had become significantly more expensive than where it was 2.5 years ago. So we thought that was the priority in terms of capital allocation was pay down floating rate debt and restore greater financial flexibility on the balance sheet. And that would then allow us to be more nimble, more flexible in where we took the company next. So yes, we fully repaid the revolving credit facility, and it allows us to seize on some opportunities as and when we see them, recognizing some of the thresholds that we'd need to meet in order to justify new investments. But certainly we don't at this point envisage increasing the revolving credit facility significantly. So we'll keep an eye on that. It doesn't say that we won't use it for things, but we'll pay it down. In terms of sort of more structural debt, we do have a long-term piece of debt in there, which is fixed rate, and it's over 10 and 12 years. We launched that last year. And that was, again, we wanted to term out some of our floating rate debt. So it's 150 million, and that allowed us to fix in at a lower rate than the revolving credit facility was charging. But importantly, the tenor of that is matched to some of the capital redemptions that I was talking about with the PPP portfolio. So the 10 and 12-year tenor means that effectively we can bring forward that capital reinvestment from those PPPs expiring in those years, and actually reinvest the money now, which is what we've done. So we see that as a more productive output going forward.
Cool, thank you. I put this slide up because it. It's just interesting from the point of view that where the secondaries are trading and then where your discount is. It sort of seems a bit strange. Where you're obviously buying back some shares. There's a specific question here saying, can you talk a bit more again about why you think the discount opened up? But can you sort of also theorize about why it might close again, please?
Yeah. So look, we think this dynamic is a bit strange, and we term it sort of a dislocation between valuations for these assets between public and private markets. So I think the first thing to highlight is that the private market for high quality infrastructure remains alive and well. So we've top left of this chart, you can see their deal activity. We have sort of total infrastructure deals on the left axis, but sort of our view of the world, the core infrastructure deals in our sectors, in our geographies, on the right-hand axis. So in Q1 2024, we had around 58 transactions occur. Now, 2 years ago, that was in the 90s, so it's come off a bit, but still very, still a very active period, and that's important because it goes to asset liquidity and it goes to valuations. And clearly, we've been active in as part of that in selling the assets that we've sold, and we've been able to attract very good pricing for those assets. So the bottom half of this page deals with the dislocation a little bit more clearly. So what it does on the bottom left, you can see private market secondary. So this is when limited partners in unlisted infrastructure funds sell their stakes in those funds to other limited partners. And the reason that we use secondaries is it's a little bit more objective than GPs or infrastructure managers self-reporting their own valuations. Secondaries usually trade at a bit of a discount, just reflecting the liquidity or the illiquidity of those private fund instruments. But you can see here that infrastructure trades at the tightest discount of all of this selection of alternatives within secondaries. So only a 7% discount, and that was broadly where it was in when we presented this same chart in November. You compare that to the right-hand side of the slide, and you've got infrastructure trading at an 18% discount within public markets. You compare that to real estate, and in real estate, you've got about a 30% discount in secondaries, and you've got about a 30% discount in the listed market. So those line up a lot better. So we think it's a little odd that the public market valuation is as low as it is for infrastructure. In terms of how that closes, I think a lot of this is around the interest rate environment. There's two factors within that. One is that there's been a significant shift in the interest rate environment. And whenever there's big changes in the backdrop, that can limit or reduce the amount of capital that's out there on the buy side. And then there's the higher rate environment themselves. Now, infrastructure has suffered in particular from this view that infrastructure is a bond proxy. And therefore, all of the infrastructure stocks have traded very much in line with wherever gilt yields are. And the correlation between HICL and other of our peers and bonds has gone up significantly. Now, we would argue that this characterization is wrong. Infrastructure offers very long dated cash flow, so very long duration. It offers growth, it offers inflation correlation, which set it apart from bonds. So we think this characterization is wrong, and that's what's impacting public market valuations. We're not seeing that dynamic in private markets. So private market investors are looking at the assets in a different way. They're looking at DCF cash flow modeling, and yes, return expectations might have gone up a touch. We have also increased discount rates, but those impacts are often offset by higher inflation assumptions, higher deposit rate assumptions, growth assumptions, all of which are really important for the asset class. So I think going forward, what will change? Greater certainty around the rate environment, greater comfort that not only has it peaked, but it's starting to turn the corner. And then I think people will focus back in on the sector and the great risk-adjusted returns that are available over and above bonds from infrastructure investments.
Great, thank you. Now, just one on the opportunities that are available at the moment. So, obviously, one of the things we've got coming up now is an election. But you've highlighted already there's quite a lot to do in terms of renewing existing infrastructure. I mean, when the RAC thing came out, there was a talk about maybe we could have another building schools for the future type program or something like that. Do you see chances of return to PFI PPP type contracts? with a new government or something similar that you can invest in? Or if not that, then where do you see the opportunities going forward?
Yeah, in short, I do see that. Yes, I think the state of decay of infrastructure has become more and more apparent, and we've, even just over the last year in the UK, we've seen schools with aerated concrete closing in their hundreds. We've had hospitals with asbestos and aerated concrete needing significant remediation. We've seen articles this week on prison overcrowding. So there is a huge need for investment. And one of the reasons that there is this need is that the PFI model in the UK stopped being used. So we had huge success in delivering over 700 assets across these sectors. And then it stopped, and it became a little bit of a political football between the two major parties, and that led to a stalemate on new infrastructure procurement in those sectors, which is a shame. So going forward, I think there's a much more constructive dialogue around recognizing the need, and I think that's fairly unavoidable, and also recognizing the role that the private sector has to play in that delivery. The government balance sheet has only got worse over the last 10 years. And we were looking at a National Infrastructure Commission report, I think earlier in the week or late last week, which noted that they expected 2/3 of the infrastructure spending requirement in the UK to need to come from the private sector. So we are seeing some green shoots there, and even the shadow cabinet has been engaging in a fairly healthy dialogue with the private sector around how they can harness private sector capital. That can come through a few different models. We've heard of the regulated asset-based model being used more widely and has been adopted in some sectors. Nuclear, for example, probably not one for us. And also, there's talk of sort of a revision to a PFI model. I mean, it will have to be called something different, but we've seen in Wales, for example, a mutual investment model which seeks to address some of the shortfalls, perceived shortfalls of PFI procurement in the past, and that model has potentially some legs to capture private sector capital. One of the first projects has got off the ground now in Wales using that model. So yeah, there are some green shoots there. I think more broadly, we've highlighted that the opportunity for infrastructure extends beyond government procurements. And so what you've seen from some of our more recent investments is high quality infrastructure where you're less dependent on a government to anchor the contract. For example, high quality toll road investments, High Speed 1, where we have exposure to Eurostar train travel between the UK and France, as well as assets like 40 South, a mobile towers company that we bought in New Zealand, which benefits from effectively a 40-year contract with Vodafone New Zealand for the use of mobile network towers. So there is this ability to attract high quality customers to infrastructure that is outside of the government, and we see opportunities in that space as well.
That's great, thank you. One last question before we go. So I want to ask you about inflation. So obviously, a lot was made when the funds were launched about the inflation linkage. So what was the experience as we've had this bout of inflation that's now sort of easing again? What was the experience with HICL in terms of how that affected your revenues and how much flowed through? And to what extent can you sort of link the dividend with inflation going forward, please?
Yes. So when these funds were launched and since, they've all used the same terminology to describe inflation. Effectively, that's been to describe the portfolio as, say, 0.8 times inflation correlated, or recently for HICL 0.7 times inflation correlated. And what that means is that if you increased your inflation assumption for all future years by 1%, then you could expect the return from the portfolio to increase by 70 basis points. So in our case, we've got an 8% discount rate, which implies an 8% expected return. And if inflation was 1% higher for all future years, that would go to 8.7%. So that's how it works on a NAV basis, and that's how the companies have been describing it. Now, you're rightly pointing out that people want to know more clearly what happens on a cash basis. And it's fair to say that for infrastructure assets, that the inflation correlation doesn't flow through to the equity distributions immediately. So there are three things going on in the HICL world, which describes why it hasn't come through right away. First is that it takes some time to flow through the contract. So inflation itself is a lagging, needs to be recorded for a previous period. Then that goes through the models, through the banks, et cetera, et cetera. And so that process can take about 18 months before it flows through into the bank account. Secondly, there's been some operational considerations around certain assets, which has meant that we've had reduced distributions from some of our more highly inflation correlated assets. So Affinity Water, we've been reinvesting some of the equity cash flows back into the business in order to build out the investment program and reduce gearing. High Speed One, for example, we were being more prudent on distributions while it was recovering from COVID. So, there's some asset level considerations as well. And the third element is more strategic, which is that we have effectively reinvested some of the inflation-linked cash flows into assets which generate the long-term earnings profile for the company. So effectively traded some of the short-term cash for longer-term earnings, which we see as strategically important for the dividend. So our, in relation to future dividends, we've obviously guided dividend growth. It's a touch below inflation. We have, that's effectively a resumption of dividend growth after having it paused for a while. So, we need to start somewhere there. But certainly we are looking at our ability to continue to increase the dividend over time, and inflation, we recognise will be a key benchmark for lots of our investors.
Brilliant. Thank you very much indeed for that. That's really helpful. I hope that explained a few things to people. So we'll get you back again in a year or so and see how things have been going. But thanks very much for today.
Terrific. No, James, thanks very much for having me. It's been great.
So next week we're back, I say. So we've swapped out Odysseum for Polycat Global Financials. There's much going on in that world. So we actually talked to Nick yesterday, and he's got something to tell us, so it's helpful. And I've got TBD on 21st of June. We are doing our next quarterly panel slot there. So we're going to be talking about discounts generally. That's the plan. And I think we've got our first speaker lined up for that. And you'll hear more about that next week. So full lineup of stuff going forward. Hopefully I'll see you next Friday, and have a great weekend. Thanks very much.